I think in general it still is different parts of the same market, and it's all real estate financing. But for regulatory purposes, for, as we heard before, the general legacy model of Pfandbriefbanken in Germany compared to insurances entering this market that have completely different business models to it, as well as true alternative capital providers. On the one side, on the supply side, so to say, it's going to be different markets. For a borrower, it might start to feel like one market where he's getting debt, and he'll see people working together on, it's not club deals, but sort of coming together for certain situations, and providing capital for different parts of the risk curve. But I think it's still decisively separated markets.
I don't think alternative is a bad label. Yeah, it will come more and more in Europe because the regulators are also driving it. If you compare Europe to the US, yeah, in the US there's maybe 20% of the lending on banks' balance sheet. In Europe, it's the other way around. It's almost 80%. Balance sheets of banks have ballooned in the last few years, contrary maybe to common expectations in the market after all the restructurings done in banks. But the total volume has not gone down, and the regulator in Europe, in my opinion, is basically trying to get a situation like in the US, where much more is done in the capital markets and not on banks' balance sheets, in order not to have the risk to save them again. Yeah, so it's not a bad label. If it's not for the regulator a bad label, it should not be for us. Yeah, so that movement will continue in Europe. We are way far behind the United States.
Okay, good. Yep, go ahead.
I think Sascha's point about the regulator is very good. I think the question I ask in return is, what is the approach being adopted by EIOPA in applying Solvency II to the pension funds and their allocations to debt products? Because they're now tightening up the capital adequacy requirements to pension funds allocating into the debt space. So we have almost two conflicting positions by two regulators, one by the banking regulator in Europe and one by the pension funds and insurance company regulator, both trying to tighten up capital constraints. And if we're not careful, that lack of joined up thinking could squeeze the alternative providers of debt finance away from actually making those allocations and diversifying sources of debt across the market.